Today, we're doing a complete breakdown of Indian Accounting Standard 1. We'll cover the scope, core principles, measurement, journal entries, and real interview questions. Whether you're studying Indian Accounting Standard, prepping for a Big Four interview, or working in finance, this is everything you need to know. Before Indian Accounting Standard 1, financial statements often lacked consistency, making it tough to compare companies. Imagine trying to assess a company's performance with no standard format. Indian Accounting Standard 1 introduced a structured presentation approach, ensuring all financial statements are comparable and clear. By the end of this section, you'll grasp how this standard transformed financial reporting. Indian Accounting Standard 1 emerged to standardize the presentation of financial statements. Previously, diverse formats across companies made comparisons challenging. This standard mandates a uniform approach, ensuring clarity and comparability. With consistent reports, stakeholders can make informed decisions, knowing they have transparent and reliable data at their fingertips. This transformation enhances trust and facilitates better investment choices. Indian Accounting Standard 1 applies to all listed companies and significant unlisted entities in India since April 2016. Its most crucial provision is the requirement for a consistent presentation model. This ensures that financial statements are comparable across different companies. By adhering to this standard, businesses provide stakeholders with clear and consistent information, facilitating accurate analysis and decision-making. The presentation model under Indian Accounting Standard 1 organizes financial statements into recognized sections like profit and loss, balance sheet, and cash flow. This structure ensures companies report consistently, providing transparency. When preparing for finance interviews, mastering this model is key. It enables you to discuss financial reporting confidently and demonstrates an understanding of essential accounting principles that drive investor trust and decision-making. Understanding what Indian Accounting Standard 1 covers is crucial, because a common pitfall is assuming it includes specific guidance on recognition and measurement. It doesn't. Interviewers often trap candidates by testing if they know this standard focuses on presentation, not those technical details. Knowing these boundaries can make or break your interview success. This standard zeroes in on ensuring consistency in the presentation of financial statements. It meticulously defines how assets and liabilities should be categorized, impacting how financial health is perceived. Think of it as the blueprint for financial statement architecture, ensuring that stakeholders get a coherent picture of an entity's performance and position. While Indian Accounting Standard 1 lays down the layout rules, it leaves recognition and measurement to other standards. This is where candidates slip, assuming it covers intricate measurement protocols. If you're asked whether industry-specific presentations are within its realm, remember, they aren't. This is the interviewer's classic trap, testing if candidates know the limits of presentation focus. Think of financial statements as a company's comprehensive profile. They're not just numbers, but a narrative of financial health and performance. By examining a balance sheet, stakeholders can assess whether assets exceed liabilities, a critical factor for assessing solvency. For instance, when a company shows $6 million in equity, it's a clear indicator of its financial standing, offering insights into potential growth and stability. Current assets are the lifeblood of a company's liquidity, ensuring it can meet short-term obligations. For instance, cash in hand or inventory ready for sale within a year are critical indicators of operational efficiency. Consider a retailer with $500,000 in inventory. It represents not just stock, but potential revenue, underscoring how these assets fuel daily operations and financial agility. Navigating Indian Accounting Standard 1's scope can be tricky, especially with edge cases. When asked if it dictates revenue recognition, you should know it doesn't. That's a different arena. Similarly, while it covers asset classification, it steers clear of inventory valuation specifics. Recognizing these lines is crucial for understanding where this standard starts and stops. Imagine a company attempting to secure funding with unclear financials. The presentation model of Indian Accounting Standard 1 standardizes reporting, ensuring clarity and comparability. This process is essential for investors, lenders, and management to assess the financial position and performance accurately. Here, we'll explore how a structured approach transforms raw data into a coherent narrative. The presentation model in Indian Accounting Standard 1 guides the structured presentation of financial statements through 5 vital steps. This ensures stakeholders receive complete and comparable information. We'll follow Meridian Corporation, which signs a $10 million SaaS subscription contract with Acme Incorporated, $8 million for software and $2 million for services. This example will demonstrate how the model transforms complex transactions into a clear financial narrative. Meridian Corporation's financial reporting starts by identifying key components: balance sheet, income statement, cash flow statement, and comprehensive notes. For their $10 million SaaS contract, the $8 million software license and $2 million implementation services must be clearly identified as distinct components. Missing these elements can lead to incomplete financial reporting. Indian Accounting Standard emphasizes detailed notes to ensure stakeholders fully grasp the financial intricacies and obligations. This identification sets the stage for accurate classification. Building from component identification, Meridian Corporation now classifies assets and liabilities. The $8 million software license is non-current, while the $2 million services are current due to immediate realization. Misclassification often stems from liquidity misconceptions. Indian Accounting Standard demands assets and liabilities be classified by expected realization or settlement timeframes. This distinction impacts financial ratios and assessments, setting the stage for presenting a clearer statement of financial position. Meridian Corporation's next task is presenting a structured statement of financial position. The $8 million software license appears in non-current assets, while $2 million services feature under current assets. Mistakes often occur in equity classification, muddling assets and liabilities. Indian Accounting Standard emphasizes distinct classification for clarity and user understanding, enhancing financial decision-making. This structured presentation lays groundwork for the subsequent profit and loss statement. Meridian Corporation's statement of profit and loss must detail revenues and expenses. The $8 million software license and $2 million for services directly influence revenue and profit margins. A frequent error is misalignment of expenses with revenues, leading to distorted profits. Indian Accounting Standard mandates that revenues and corresponding expenses be matched, ensuring accurate portrayal of profitability. This clear profit presentation informs stakeholders of the company's financial performance. Finally, Meridian Corporation needs to disclose significant accounting policies influencing its financials. This includes revenue recognition methods for the $10 million SaaS contract. Omitting these disclosures can result in stakeholders misunderstanding financial data. Indian Accounting Standard emphasizes detailed disclosures to enhance clarity and comparability across companies. This thorough disclosure approach ensures stakeholders fully grasp the underlying judgments and estimates, completing the financial narrative. The measurement method you choose directly impacts your balance sheet. A wrong choice can overstate assets by millions. Indian Accounting Standard 1 guides you on what needs disclosure. Understand how these choices affect your financial story and what must be transparent to stakeholders. When recognizing an asset, you must capture it at cost, including all directly attributable expenses. Indian Accounting Standard 1 demands that liabilities appear once there's a present obligation. Recognition hinges on probable economic benefits. Missing this could lead to misstatements. A materiality threshold ensures immaterial items don't clutter financial statements. Post-recognition, assets face impairment assessments, either annually or when evidence suggests a decline. Liabilities might require revaluation if future cash flows alter significantly. Depreciation systematically reduces asset value, aligning cost with revenue. Fair value adjustments are essential for aligning financial statements with current market dynamics, ensuring transparency and accuracy. Balance sheets categorize assets and liabilities as current or non-current. This crucial distinction affects liquidity analysis. The income statement dissects operational results, essential for performance evaluation. Detailed notes reveal the story behind the numbers. Classification rules streamline presentation, aiding in consistency. This structure supports stakeholders in making informed decisions by showcasing financial health clearly and accurately. Understanding the company's accounting policies helps analysts grasp financial reporting methods. Disclosing estimation uncertainties highlights potential variances in reported figures, crucial for risk assessment. Management's judgments in policy application shed light on strategic decisions. Capital management information is key to evaluating financial strategies and understanding how a company navigates financial risks, providing a comprehensive view of financial health. Imagine a CFO navigating a $10 million property decision. Opting between cost and revaluation models dramatically influences asset valuation. Misjudging inventory measurement can skew net income by $500,000. Fair value changes in investment properties could shift earnings significantly. Disclosure around estimation uncertainties in revenue recognition explains unexpected variances, potentially by $1 million, ensuring stakeholders understand the financial context. Meridian Corporation, a global manufacturing company, signs a 5-year operating lease for its Singapore warehouse. Watch how every accounting event plays out. Indian Accounting Standard 1 requires recognizing both a right-of-use asset and a lease liability at the commencement of the lease. This entry captures the present value of lease payments, impacting both assets and liabilities equally. Meridian's balance sheet now shows a $1,200,000 asset and an equivalent liability, reflecting the financial commitment and the control over the asset. The first lease payment reduces the lease liability on Meridian's balance sheet by $240,000, while decreasing cash by the same amount. This transaction demonstrates the dual impact on financial position, lowering both assets, cash, and liabilities, lease liability, by the payment amount, keeping the balance sheet in equilibrium. Indian Accounting Standard 1 mandates systematic depreciation of the right-of-use asset over the lease term. Meridian depreciates the $1,200,000 asset by $20,000 monthly, affecting both the income statement and accumulated depreciation. This reflects the asset's consumption, impacting net income while maintaining asset accuracy on the balance sheet. Interest accrual is necessary to reflect the finance cost of holding the lease liability over time. Meridian records $10,000 as interest expense, increasing the lease liability. This ensures accurate interest representation on financials, affecting net income while aligning liability with unpaid principal balance. Indian Accounting Standard 1 allows for year-end adjustments to reflect changes in future lease payments. Meridian records a $15,000 gain on lease adjustment, decreasing their liability. This entry ensures that the balance sheet correctly reflects the updated present value of future lease payments, maintaining financial statement integrity. Upon lease completion, Meridian settles the outstanding liability of $945,000 via cash payment, removing the remaining balance from their books. This transaction finalizes the financial obligations under the lease, impacting cash flow significantly, while reinforcing the accuracy of liabilities reported during the lease term. The derecognition of the right-of-use asset marks the end of the asset's life cycle. Meridian reverses the accumulated depreciation against the asset's book value, effectively removing it from the balance sheet. This clears the asset accounts, ensuring no residual values remain, and closes the loop on the asset's usage and financial impact. Every Big Four and investment bank interview on Indian Accounting Standard 1 follows a pattern. Here are the 10 questions that come up again and again, with answers that will make your interviewer nod. Indian Accounting Standard 1 sets out the overall requirements for financial statements. It exists to ensure consistency and comparability across companies. Indian Accounting Standard 1 mandates how statements are presented, aiming for clarity. Common errors include neglecting the true and fair view requirement. Remember, consistency is key in financial reporting. Indian Accounting Standard 1 requires separate presentation of line items to enhance clarity and provide distinct financial insights. This helps users understand an entity's financial position better. A common trap is merging significant items, which can obscure true performance. Core presentation leads to informed decision-making. Reclassification adjustments are recorded to shift items between equity and profit or loss, as required under Indian Accounting Standard 1. This ensures past financial statements remain comparable. Forgetting to adjust comparatives is a frequent mistake. Always check that all periods reflect the reclassification correctly. Indian Accounting Standard 1 classifies assets and liabilities as current if expected to be settled within 12 months. Non-current items extend beyond this period. The trap is mismarking liabilities like loans with rolling terms. Always verify the settlement timeframe to avoid misleading classifications. While Indian Accounting Standard 1 closely aligns with international financial reporting standards, India-specific economic conditions lead to additional disclosures. Examples include more detailed segment reporting. Misunderstanding these subtle differences can lead to incomplete reports. Always reference the latest Indian Accounting Standard guidance for accurate disclosures. Indian Accounting Standard 1 requires entities to assess their ability to continue as a going concern. If doubt exists, disclose it in the financial statements. A common pitfall is overlooking this disclosure, risking audit issues. Always document management's plans to mitigate the doubt. Indian Accounting Standard 1 requires disclosure of an entity's objectives, policies, and processes for managing capital. This includes any changes during the period. Forgetting to disclose changes in strategy can mislead stakeholders. Always provide a comprehensive view of how the entity manages its capital base. Significant accounting policies provide clarity on how financial statements are prepared. Indian Accounting Standard 1 requires their disclosure to ensure transparency. Overlooking key policies can obscure financial results. Always ensure full disclosure to align with stakeholders' needs for transparency and comparability. Items relating to changes in equity that are not the result of transactions with owners are excluded. The trap is incorrectly including such items which can misstate profits. Accurate classification ensures financial statements reflect true performance. Indian Accounting Standard 1 mandates subclassification of each significant item, like assets, liabilities, and equity, based on their nature and function. A trap is neglecting these, leading to a lack of detail. Always subclassify to provide stakeholders with comprehensive insights into financial position. Indian Accounting Standard 1 sets the stage for financial clarity. The main goal here is comparability across financial statements, crucial for stakeholders. It applies universally to entities under Indian Accounting Standard. Familiarize yourself with the balance sheet, income statement, and more. Remember, a true and fair view is non-negotiable, as is the going concern assumption, unless liquidation looms. Everything runs on accruals, with materiality guiding presentation. No detail too small if it impacts understanding. The presentation model under Indian Accounting Standard 1 requires clarity in financial statements to guide economic decisions. Classifying assets and liabilities as current or non-current is vital. Offsetting is a no-go unless another standard says so. Historical cost, current cost, and others define measurement. Comparative information from past periods adds context. Consistency in presentation ensures reliability, while annual reporting keeps everything timely and relevant. Stick to these rules for a solid financial foundation. For interviews, understand that misclassifying asset classes can skew analysis. Indian Accounting Standard stands out for its extensive disclosures compared to frameworks like U.S. generally accepted accounting principles. Always disclose key accounting policies and judgments. If compliance conflicts with true presentation, you're allowed an override, but disclosure is critical. Minimum disclosures are non-negotiable, covering judgments and estimates. Reclassification needs clear disclosure, while materiality influences presentation. Master these essentials to ace any interview on Indian Accounting Standard 1. That's your complete guide to this accounting standard. If this video helped you, please like and share. It genuinely helps us keep creating content like this. Drop your standard requests in the comments. Subscribe to Candy Mentor for more accounting and finance videos.